Great, thank you, Tara. Good afternoon, everybody. As Tara said, thank you for joining us today for the Pennsylvania tax update. There's so many topics right now that we could talk about. It's kind of an exciting time in the state and local tax world with all the income tax reform that's going on and implications for states, and as well as on the sales tax side with the recent Supreme Court decision in South Dakota versus Wayfair. But today our focus is going to be on Pennsylvania and what kind of steps need to be, an overview of what needs to be done in order to be in compliance with the tax laws of Pennsylvania. So our presenters today are Stacy Roberts. Stacy's a state and local tax senior manager out of our Denver office. Laura Robichaud is a state and local tax senior manager out of our Phoenix office. And I am Jennifer Edwards, state and local tax manager, and I'm located in Sioux Falls. So as I mentioned, today we want to touch on areas of compliance, areas that we see questions on in regards to our clients that are looking to maybe expand their business or they're making sales into Pennsylvania. What kind of, what implications does it have for them from a sales and use tax perspective, from an income tax perspective? What do they need to do to get started with that business, be in compliance, or maybe get themselves in compliance if they've been doing business there? So I'm going to start off by talking about registering a business in the state, when to register, what are the steps, who needs to have a sales and use tax license in Pennsylvania. Laura will then move into more in depth on the sales tax side. She's going to talk about Nexus, various taxes that are out there, sourcing rules, the various types of sellers that are recognized in Pennsylvania. And then she'll also talk about some recent tax rulings to consider on the sales and use tax side. Stacy will then talk about, move into income tax. She'll talk about different Pennsylvania income tax for businesses, talk about Nexus, the corporate tax regime, talk a little bit about apportionment, what does that mean for entities, talk a little bit about pass-through entities and some of the impact on those types of entities, touch on some tax reform issues. Then she'll also talk about some local income taxes in the different cities, Philadelphia, Pittsburgh, etc. And then I will wrap up with just what do you do if you are no longer going to be doing business in Pennsylvania? If you had registered for sales and use tax, what do you need to do to cancel that registration? So we'll get started here by just registering for Pennsylvania sales and use tax. So who needs to be licensed? Well, Stacey and Laura will talk more about Nexus and kind of the nuances of Nexus for the different types of tax. So, but just as a quick FYI, Pennsylvania is a state that does still have a physical presence requirement for Nexus. So that being said, who needs to be licensed? Any and every person, fiduciary, partnerships, corporations, or any entity that are making taxable sales of tangible personal property or taxable services in Pennsylvania must register for sales and use tax license. When we talk about physical presence in the state, that would be they have a business location in the state, have employees in the state, then you have inventory, or they store property of some sort in the state. That would be enough to be give them physical presence. If you have a requirement to be licensed and you don't do that license or don't register and you make sales, there is a fine that such a business could face if they're not registered. Out-of-state vendors also may have to be making taxable sales in Pennsylvania are required to register for sales and use tax license, and we'll touch on that in a little more detail in a few minutes here. But also, if you are making purchases of items that taxable purchases of items that are going to be used in the state of Pennsylvania, and no sales tax was charged on that purchase, then use tax is due. And in order to remit that use tax on the Form PA1, you do need to be registered with the state of Pennsylvania. So quickly, just want to touch on the types of sellers in Pennsylvania, because Pennsylvania does now, they did enact legislation that puts a taxing requirement on out-of-state or types of vendors that do not have a physical presence necessarily in the state. So we have marketplace facilitator, and that it would be somebody that just facilitates a sale at retail by advertising or listing the tangible property or the taxable service for sale. They collect the payment from the customer and transmit the payment to the seller. In most cases, that would be, they would have a relationship with a marketplace seller, and that is just the seller has an agreement with a marketplace facilitator, but the seller is actually the one who is selling the product. A referrer is somebody that has an agreement with a marketplace seller or a remote seller. They basically link or send the purchaser, the customer, to the seller's website or whatever their medium is for selling their products, and then the seller actually completes the transaction. And then a remote seller is essentially what, as the title says, it would be a seller, a company that is doing business, making sales to customers in Pennsylvania, but does not have any physical or any place of business in the state. So I want to just first go to this slide. So an out-of-state business, would they need a sales tax license? And an out-of-state business could still have some kind of a physical presence. So obviously, if they have a physical presence, they would need a sales tax license. But some other times they might have a requirement to have a sales tax license if they have a contractual relationship with individual or other entity physically located in Pennsylvania. They solicit sales regularly. A lot of these really refer back to what you would think of as the referrer or the marketplace facilitator. But then also, if you have inventory in the state, so potentially selling through Amazon FBA, have inventory in the state, or at some other property stored in the state. That is another example when an out-of-state business would need to be registered. But I also then wanted, as I mentioned, Pennsylvania has passed legislation that essentially what they're trying to do is level the playing field between out-of-state retailers and in-state retailers. So they've established this marketplace sales tax collection, notice, and reporting requirement. And this requirement was effective March of 2018. And so what this legislation did is it gave marketplace facilitators, referrers, and remote sellers an option to collect and remit sales tax, so either to register and collect and remit sales tax, or they could choose to just notify their customers that use tax may be due, and then along with that, they'd also have a requirement to report to the state annually on their Pennsylvania customers, such as their name, the volume of, the quantity of sales, and so forth. And the threshold for this reporting requirement may sound similar. There's other states that have also put in these reporting requirements in place. But the threshold for Pennsylvania's rules are $10,000 in Pennsylvania sales during the last 12 months. That is the threshold that you'd need to either have to register to collect and remit sales tax, or you follow the use tax and reporting requirements. And just as an FYI, the reporting requirements for failing to comply, those penalties can be very stiff. I believe there's a potential $20,000 penalty if you are not complying with those rules. So it is definitely something to keep in mind if you are an out-of-state retailer making sales into Pennsylvania. So if you have determined that yes, you meet those requirements, what do you need to do to get registered? And a key piece here is that you should always do the application and get the license before making any taxable sales into the state of Pennsylvania. A Pennsylvania sales tax license must be renewed every 5 years. And it's an online registration that you can do. The website is right there. If you go to the website, you click on that, select register online. You create an account, use your federal identification number as the application ID. Get that set up and go through that. There is also a paper form available if you don't want to go through the online process. The online process is more efficient and does get the registration done much quicker. And that process can be used if you're registering a new business, if you are acquiring an existing business, or if you're even just adding additional taxes or services. So that registration can be done, that form can be used for more tax types other than just sales and use tax. But that is the form that you would need if you're required to be registered with the state. And so just quickly, I want to touch on the South Dakota versus Wayfair, the Supreme Court decision. Everyone's probably well aware of that decision that came out last Thursday. It essentially overturns the Quill decision and the physical presence requirement in states in order to require a state to collect sales and use tax. The Supreme Court decided in favor of South Dakota, and their rule says if you have $100,000 of sales or 200 separate transactions into the state of South Dakota, that is enough to give that seller Nexus and require them to collect sales tax from their customers in the state. So essentially, with this decision, retailers may now be required to collect and remit sales tax where they have no physical presence. There are a number of states that had similar laws to South Dakota's with $100,000 in sales or 200 separate transactions. So far, North Dakota is the only state that has come out with a definitive start date of when you have to start collecting. They are saying it is October 1st, 2018, or 60 days after the entity reaches that threshold, whichever is later. Just something to keep in mind if you're making sales in North Dakota. But just at this point, there's still a lot of information that we're waiting for. States are reviewing the decision to determine how this will impact them and how and when they want to implement and put their laws in effect. So we will continue to monitor this. This is not run out and panic and quickly register in every state. There's a lot more to come on this. So we will be monitoring that. Ideally is working on putting a presentation together on this decision so that hopefully in July, at the latest August, we will be watching for that, and we will come out with more information. But at this point, we just want to make everybody aware of that. And from the standpoint that Pennsylvania has the reporting and use tax, or they had the option to start collecting and remitting if the sales are 10,000 or more into Pennsylvania. So their threshold is actually significantly lower than the South Dakota threshold that was ruled on in the Supreme Court decision. So with that, we'll go to our first polling question. Use tax notice and reporting requirements are being adopted by more and more states. The consequences for not complying can be significant. How aware are you of the states that have reporting requirements? 1, I'm very aware and have taken steps to be in compliance. I've heard about it, but I've not taken any action to become compliant, or this is the first that you're hearing about it. All right, we have some results there, Tara. Oh, good. Looks like the majority at least are aware and have taken steps. So that is great news, because as we mentioned, those penalties for not complying can be significant. All right, with that, I will pass it over to Laura.
Thanks, Jennifer. Hopefully you can hear me, or everybody can hear me. So I'm going to talk about sales tax, which, this next slide, the Nexus slide, if we do any more of these states, we're probably going to have to switch this up, given some of the changes that Jennifer had mentioned with the Wayfair case. But as of right now for Pennsylvania, they have pretty much the same Nexus rules as a lot of the other states. And this is something where, depending on what kind of industry you work in, is going to impact you differently. So, for example, we have a lot of the clients that I particularly work with are either construction or retail or sometimes some sort of software company. You don't realize that utilizing third parties or maybe somebody comes into the state to execute some contracts. Anytime you enter the state to do anything, you could be potentially creating Nexus for yourself. Now, I'm not talking about, the onesie twosies where you go in and, maybe it was an outlier of your regular business. I mean, when you're doing your annual review with your sales by state and you look at, man, we really did some revenue in Pennsylvania, or we sold a lot of products into Pennsylvania, but we're not licensed there. That's something that I would really consider looking into more in depth. So as this Wayfair situation begins to evolve and we anticipate and see more and more states coming forward with, well, now this creates Nexus, because physical presence might be more of a thing of the past, even though the states aren't quick to move on everything. This listing, this very general listing, is going to change. So just as of right now, this is what it is, but I wouldn't bank on this. I would just say that it's possible that it's going to change, and this isn't just for Pennsylvania, this is also applicable to other states too. PA has some pretty normal different types of sales tax. They have, well, of course, sales and use tax, but like many other states, they have like a hotel occupancy tax. Sometimes they call it short-term rental tax or something. And anytime there's any hospitality, you'll find that there's an additional ad tax, and there might even be one more layer at the local municipality level of an ad tax on top of that. They also have a fireworks tax. I don't know if you guys deal in the fireworks industry, but they do have that tax just for that. It's very similar to the liquor and tobacco tax. They have a rental tax, and they also have what they call PTA, public transportation assistance tax. So it's not as many. I think the last state we did was Florida, and they had a ton. This is pretty normal and what we would expect to see from a state like Pennsylvania. So, just be cautious of, if you're in the telecommunications industry, usually there's always an additional 911 tax that's attached. So that I didn't include that because that's pretty normal. But just pretty high level, that's what we have. Just the sales tax, use tax. Those are the ones I would be worried about. We also kind of want to touch a little bit on, what's taxable in Pennsylvania. I hear all sorts of things about medical supplies, drop shipment stuff, digital products. They actually, Pennsylvania, Arizona, I think it's Nebraska, they are one of the very few states that has what we call taxability matrix. So you can go online and look, and it breaks everything out by product. That's actually really helpful if you're in the hotel industry or you are a builder or constructor of hotels. I put mushroom farming on here just because I thought it was so unique, like that they would actually list that on their website as one of their top things. So apparently mushroom farming is exempt, but there are some things with mushroom farming that are not exempt. Pennsylvania is one of the very few states, and I'm going to go into this when I talk about some of the recent case studies, but they tax digital products, and digital products now we see are becoming more and more common just because who doesn't get stuff on their smartphone? Everybody does. It's just, and there's software that's attached to that too, so is the software considered a digital product? So This is pretty normal. If you happen to be someone who is a retailer of medical supplies, just like any other state, there are some devices that are considered exempt. However, there's a lot of things that are going to be considered taxable. So if you're selling what we call TPP, which is tangible personal property, and services, because a lot of services are taxable in Pennsylvania, we need to talk about sourcing. So in every state that we've done, Jennifer, Stacy, and I, we've talked about sourcing, and sourcing is so important. So for example, I live in Arizona. We're an origin-based state, just like Pennsylvania. So if I am a retailer, my sales tax rate is based off of where my brick and mortar building is. I'm in Phoenix, so therefore my sales tax rate is from Phoenix. Pennsylvania is the same way. If you're in Pittsburgh, your sales tax is going to be Pittsburgh. Not all the states function that way, so a lot of states are based off of where you're shipping to, and Pennsylvania is not set up like that. So it is, the confusing part about this is if you have a location in Pennsylvania, like an actual physical location, you're going to use that address to determine your sales tax rate. But if you're an out-of-state retailer or online provider of digital goods, you would be using more of a destination base because you don't have anything that actually tethers you to a physical location in Pennsylvania. So if you're operating in multiple states, I would encourage you to talk to whoever your sales tax guru is to determine if you're charging the right sales tax rate, because the origin versus destination is really going to vary. And unfortunately, it's not the same for all neighboring states. So that's just something to consider. And also, if you're thinking about setting up a software program for automation, you're going to also need to know that as well. So sales and use tax incentives, it's not all doom and gloom. Not everything is taxable. Pennsylvania has quite a few deductions. They're not huge. There's the normal ones like reselling equipment or property. Wrapping supplies are surprisingly exempt, and that includes crates and containers. Sometimes, any sort of tourist type of material, that's going to be exempt. Anything that's considered quote unquote out of state sales are exempt. They also have some interesting what they call zoning exemptions. Now we see this in California too. Usually we would see anything that is an opportunity expansion or land and expand type of credit. It's always on the corporate side. But there's a couple of states that have sales tax deductions. So if you're working in a certain zone, maybe it's a lower socioeconomic class zone, or maybe it's, they're going to build a stadium or something, or it's considered a special district, they might have a sales tax deduction for materials or something like that. So Pennsylvania offers that. It's very rare that you're going to find these types of deductions in any other state. Okay, I wanted to talk about audits. This is the first time I've popped this slide in some of the state presentations we've done, and that's just because I get a lot of questions about audit, what to do, what to expect, and maybe some of you have had the pleasure of going through a sales tax audit. If you have, you probably understand what I'm saying. So during an audit, you're going to always have the pre-planning. This is where the auditor sends you a list of everything in the world they can think of to look at. Then they're going to want to schedule a call. You do a call with them. That's called the pre-audit conference. Some states call it something else, but it's usually the pre-audit conference. Information requests. This is where they send you the list and they expect it back within a period of time. Now, in this particular bullet, you can do some negotiation. So they might be asking for a bunch of multi-state stuff. They might be asking for some of your Fed information. They might be asking for payroll. They might be asking for who knows what. So it's been my experience that they ask for everything, but they don't really need to see everything. And you might not have access to all those documents. Usually there's a period where the auditors take time to do some analysis, and then they do audit finding summary. Sometimes, depending on what who your auditor is and what state you're being audited by, Pennsylvania is, I wouldn't say there's strict as some of the other states we've done audits with, but you know, they're more, sometimes the attitude you get is, well, this is what it is, and if you have a problem with it, we can discuss it in appeal. And you only get to appeal once you do your audit conference. So these are the very high level steps of an audit. There's some of these that you can do over and over again, where you go from data analysis, and then the auditor's like, well, now I want to see other reports. So that can happen. Just keep in mind that, you know, these are the usual steps that you go through, but if any of you go into an audit with Pennsylvania and you're confused and the auditor's throwing out stuff like stat sampling, or they want to do block sampling or something like that, reach out to your sales tax professional so that they can help you with it, because you don't want to get yourself in a situation where, you know, you've created a higher error ratio and now you all of a sudden have a huge tax bill. So I'm not going to touch too much on marketplace or remote sellers, because Jennifer kind of went through that already. What I will say about it, though, is when you look at this in a slide, you think, man, how did they break out all these in different subcategories, you know, like refer, remote seller? One of the things that I will say is that, you know, as Jennifer mentioned, their requirement to start identifying which transactions are occurring within their state, if you don't have Nexus, like that already happened. So if you're an entity that's doing business in Pennsylvania, but you're not licensed or registered, and maybe you don't need to be because you don't meet the Nexus requirements as of right now, then you might want to consider, you know, looking into some of these requirements, because they're going to be, I think the annual report is due in January, but I'd have to double check that. And we're seeing more and more of this as more people start to sell things online, or they offer digital downloads. Trying to click. Okay, there we go. Drop shipments. This is something I get a lot of questions on, and I tried to draw the triangle of confusion, because it is confusing. So usually what we see is it's a wholesaler, a retailer, and then you have your customer. And what we see a lot of times is companies adopt one type of model and then they apply that across how they do all their transactions. Unfortunately, there is no right answer, because your wholesaler could have Nexus, you could have Nexus, or neither of you could have Nexus, and then who's really responsible for collecting the tax? So there was actually, I think it was in 2017, a drop shipment case where there was a Virginia retailer drop shipped something into Pennsylvania, but the person who bought the item was from Massachusetts. Like, that's where the bill to was. So they went under audit. The auditor caught it and said, well, now, you know, our client was saying, or excuse me, the taxpayer in this ruling was saying, hey, well, we don't have Nexus, we don't have to collect sales tax. And then the Virginia drop shipper said, well, we don't have Nexus, so we don't have to collect sales tax. So if you have both of those saying we don't have to collect sales tax, who do you think it falls to? It falls to the customer. In this particular ruling, though, Pennsylvania said, well, if you're shipping something to us, you should collect sales tax, even if you don't have Nexus. Now, that ruling is being questioned, and it's been pushed up to a higher court, but now that some of the Nexus rules have changed and they have the remote seller reporting requirement, I don't know how that's going to last. It probably will, they'll probably have to reach some sort of out of court agreement. But what I kind of wanted to touch on here is this triangle you see in front of you of who's supposed to collect tax. I always say follow the money. So if your customer is based in Pennsylvania, the wholesaler is in Virginia, and the retailer, you know, let's say they're in California. Your wholesaler, you would need to know if your wholesaler has, or your drop shipper has Nexus. Well, if you're dealing with the big wholesalers, like many of them are, they have locations everywhere, and nobody's got really time to figure this out. If you're in type of this situation, one of the things I would suggest is you can't fit a perfect model into somebody who does hundreds of thousands of transactions per month. What you're going to want to do is figure out, you're going to probably want to take a couple of hours and figure figure out, okay, where do we have Nexus? Where do our wholesalers have Nexus? And then come up with a reasonable way to collect tax. And if you don't have tax, if you're not going to collect tax because neither one of you have Nexus, then you need to figure out if that state has a remote seller reporting requirement. Because I think right now, and Jennifer, correct me if I'm wrong, I think there's about 11 states-ish that have remote seller reporting requirements. And as Jennifer mentioned, the fees are huge. So it's just something to consider. And in this particular ruling, even though Pennsylvania didn't necessarily have the exact statute to support their argument, they still won on the audit side, and everything always has to be pushed up to an upper level. So just something to be aware of. The last one I kind of want to touch on, and I always touch on digital products, is because we see a lot of this, especially in the software as a service area, where you sell something that's a software product, it's digital download, maybe it's canned, maybe it's custom, doesn't matter necessarily, it depends on what you're doing. Pennsylvania had an audit where they said, well, we sell the product, but with that product, when we sell it to them, we also provide consulting. Well, in this particular case, the consulting wasn't always separately stated on the invoice, and they couldn't really pinpoint a value of that consulting. They just kind of paid, one big lump price. So in Pennsylvania, software, digital downloads, software as a service is taxable. Even if you don't call yourself software as a service, if you're doing anything that is remotely close to that, Pennsylvania is going to consider you a SaaS company. Any training or troubleshooting or online tech support, even email tech support, they're going to consider taxable if that service was sold in tandem with a digital product. So this case had some varying issues around it, but the main thing I want to get across is when you're billing, and I realize this is not a fan for some of the bigger companies, but you need to break out services versus tangible property or digital products. It is, in some cases, it can really help you during an audit situation. This client didn't particularly do it all over the place, but it's something that you just kind of need to be aware of. Because if you can't break it out, the state will say everything's taxable, unfortunately. So what we do see happen, and this is actually pretty clever, is you can we see companies, if you get big enough, you can separate, and of course there's always tax consequences to this, so in no way, in no means am I suggesting everybody go separate your lines of business, but if you ever have the opportunity to reorganize or you're considering it, we have seen in the past other companies separate, okay, this is just tech consulting, and then this side is just going to be just software sales. In Pennsylvania, it doesn't matter because they tax all of it, but in some of the other states, it can make a really big difference. So I think that's all I have. I'm going to pass this over to Stacy, and she's going to discuss some of the income tax nuances with Pennsylvania.
Okay, thanks, Laura. All right, so as Laura said, we're going to switch gears now and talk about income tax issues in Pennsylvania, and starting out, as we always do, with, okay, may I have to pay an income tax in Pennsylvania, and how do I figure that out? Well, actually, Pennsylvania is one of the few states that has what they consider a physical presence standard for doing business. If you've been on any of our other webinars for the other states we've done, or just have your own experience with the doing business standards in a lot of other states, they're usually very broadly written, and they tend to have more of an economic presence flavor to them, meaning that a lot of them say that if you're just generating income in the state, that's enough to be doing business in the state. And then, as you all are probably aware, we've got a lot of states out there that have their thresholds, meaning that if you sell over a certain dollar threshold into the state for income tax purposes, you could then have Nexus. But Pennsylvania so far is not one of those, and they are pretty much a physical presence standard for income tax, which, and as we know, in the wake of Wayfair, is a little interesting, because maybe for income tax purposes in Pennsylvania, it's going to be a little bit more straightforward the nexus for sales tax purposes, which hasn't always been historically the case for many other states. So, having said all that, physical presence is, as it seems, pretty obvious, traditional nexus standard, meaning having capital or property in the state, whether it's used or just being stored, owning it, having a stock of goods, deliveries in company-owned trucks, so don't forget about that. Sometimes the states may carve that out as a non-nexus creating activity, meaning that it's more akin to something that's related to solicitation. However, Pennsylvania specifies that it is part of their nexus creating activity. Again, having employees, reps in the state, soliciting business. However, as we all know, there are some limitations on that, which I'll talk about. But they also go on to state that soliciting business doesn't have to mean just having an employee or a rep in the state going and visiting customers. It could mean advertising via the U.S. Postal Service, radio, TV, newspaper, and the like. Or if you're even leasing or servicing property in the state, that's going to be a nexus creating activity, and trade show attendance. So those are very common physical presence standards or nexus creating activities. However, it's always good to kind of remember what some of these are, because maybe you're only thinking about having property in the state, but don't forget about having reps in the state. Okay, so I mentioned soliciting sales, and that there are some limitations on that, and Pennsylvania is no different. They impose a net income-based tax, so Public Law 86272 does apply, and for those of you who do not know what that is, it's a federal law which basically protects certain types of income from being taxed, and basically it is a limited standard. It's a limited law that means that basically if you have an employee or a rep that's in the state soliciting sales of tangible personal property, and the orders are approved and sent from outside of the state, then that income, those sales would be protected and not subject to tax in Pennsylvania. So they have this law, as most of you have heard in other presentations or know even from experience. Public Law 86272 is limited. It only relates to income taxes. There's no protections for sales tax, capital stock taxes, business privilege taxes, those types of things. And it's also only on the sale of tangible personal property. It does not provide any protections for services, and you can suddenly not be protected if you exceed certain limitations. So, for example, having stock of goods in the state, having property in the state, for example. So again, very limited exception. However, it is there, and I encourage taxpayers that may be selling PPP into the state to just look and see what activities they have going on in Pennsylvania, particularly if they don't have a location there, to see whether maybe their income is protected. Okay, so now we're going to come to a polling question, our next one. Do you have employees or agents traveling into Pennsylvania providing services? Yes, no, I don't know, but I better check. And our results are kind of mixed. All right, and we got a few that are going to have to go back and check, which is good to know, because if you do have individuals going into Pennsylvania, like I said, that is a physical presence, and therefore there could be a filing requirement. All right. Moving right along, I'm going to touch base on the corporate tax regime and then on pass-through entities. We'll start with our corporate tax regime. Pennsylvania, actually, in the last couple of years, has become a little bit more simplified from a corporate tax standpoint, if you can believe it. They are a separate company state, so There's not the opportunity to do a consolidated return if you have, you know, a consolidated federal group. You look at each entity on its own to see whether they have activities in Pennsylvania, and you calculate a separate company return in Pennsylvania for each entity that is doing business. The starting point is line 28 of the federal 1120. They do have a fairly high rate, unfortunately. It's at 9.99%. For corporate income tax purposes, they do not reference or incorporate the IRC code in entirety. They do adopt various provisions or select provisions, which will be important when I talk about tax reform in a moment. And as I mentioned, they did what I consider simplify their corporate tax regime a little bit by doing away with their franchise tax. I think most of you that have done business or have any experience with Pennsylvania will remember the history of earnings, where you had to list book income for the last 5 years, and then it was a rolling calculation. Each year, a year would drop off on the history of earnings, et cetera, and then it was just kind of a convoluted franchise tax calculation, and they finally phased it out. They were supposed to phase it out earlier than 2015, but then it stuck around for a couple extra years, but they finally did away with it. So starting in 2016, we didn't have the corporate or the franchise tax to deal with, and that was for corporations as well as pass-throughs, because as you may remember, pass-throughs were subject to that franchise tax as well. All right, so I mentioned tax reform and then the issue of conformity to the IRC. And for any of the states that are looking and grappling with what to do with the federal tax reform, conformity is the place to start. Pennsylvania, as I mentioned, they kind of pick and choose from the corporate standpoint what they want to adopt from the IRC. Now, what they have done with respect to federal tax reform, and what a lot of states have done, unfortunately, is just provided some guidance at this point. You know, from a federal standpoint, I know that, you know, we're still waiting for guidance on some things or more regulations. Well, as most of you know, the states are really behind when it comes to even normal situations. So this is a completely moving target when it comes to tax reform. And so what we've seen is the states maybe picking some provisions that they've taken a look at, and they're deciding, do we adopt it or not? So what Pennsylvania has done is they've actually announced, they had an information notice that came out, I think it was the end of April rather, where they did address 965, and at least what we think is going to happen now. One of the caveats, though, with Pennsylvania is that their legislature meets all the time. So what I'm telling you today could very well change, but this is at least what we know right now when it comes to 965, which for some of you on this call may not apply. However, they did put out some information about this, and they will include that, you know, the repatriated income and deduction in the state tax base. What's interesting is that, you know, that deduction, if anybody's following along with this with 965, that income and that deduction are not going to be one and the same necessarily. So Pennsylvania, and there's some other states that have adopted this as well, Pennsylvania has what's, you know, a dividends received deduction. So even though this repatriated income is really a deemed dividend, they will provide a dividends received deduction for it, but on that net number. So you're not, like I said, the income number is going to be potentially different from your deduction on the repatriated income. So that net number is what's going to be subject to the DRD. From a federal standpoint, there is that deferral election for 8 years. Pennsylvania has said we're not going to adopt that except in the case of REITs. The depreciation bullets here have been a little bit controversial. This first bullet in particular, because early on this year they indicated that they were not going to provide an adjustment for the 100% deduction under 168K. they were going to just have 100% add back with no additional mechanism for cost recovery. Well, since I think this came out fairly recently in the last week or two, oh yeah, on June 19th, it's there on the slide there, that there is a Senate Bill 1056 that has been advanced by the House that would reverse this position, and then there would be some kind of state adjustment then. And then the House had passed their version of that legislation in March. So again, as I said, Pennsylvania being one of these that has their legislature meeting on a fairly regular basis, it remains to be seen what's going to happen with this, but hopefully this position on adding back that 100% deduction for depreciation will actually get reversed. But we'll monitor that situation and see what ends up happening. Okay, now to our next polling question. So, what is the current corporate income tax rate for C Corp taxpayers in Pennsylvania? 0, 5.5%, 6.99%, or 9.99%? All right, most everybody's getting that right. It is 9.99%. Okay, so a couple of quick notes about apportionment. Pennsylvania is a single sales factor. Again, they phased that in over time, so some of you may recall that they had a couple different factors going on at the same time when they had the franchise tax, and so they've done away with all of that, obviously. They did away with franchise tax, and they've actually now gotten to 100% single sales factor. Sales of tangible personal property are based on destination. They do not have a throwback rule. They do have a market-based sourcing rule for sales of services. It's written a little differently from some of the others out there because they basically want you to source the amount to Pennsylvania based on the percentage of total value of the service that's delivered in Pennsylvania, which that could mean a lot of different things. But suffice to say that in their regulations and their statutes, that if you're not sure kind of where or how to divvy up that value of service that's delivered, then it would default to generally the billing address of the customer. They do exclude certain receipts from their apportionment factor, dividends being one of them, which can impact our 965. As you recall, we've got income coming in, we've got income going out for repatriated income. Now, they don't even include dividends in their sales factor, so it doesn't mean that you then have to maybe include a part of them in your factor that weren't otherwise excluded in the tax base. So just something to keep in mind. A couple notes on pass-through entities. S-corps and entities taxes partnerships, they file a form PA20S and a PA20S/PA65. They do have non-resident withholding. Quarterly payments are required if withholding is expected to be more than $500 for the year. And then they do allow composite returns. However, you have to have more than one member, so that sometimes throws some of our taxpayers out from being able to file a composite return. A couple notes on tax reform for pass-through entities, at least, again, what we know right now, subject to change. From an individual income tax standpoint, Pennsylvania does not conform. They're not a rolling conformity. They're not, static conformity to the IRC. They have their own, basically, own calculation that they do. And as such, then they're, just kind of going to have to provide more guidance on what they're going to adopt or not adopt for reform. And so what they've done, again, on this repatriation issue is for purposes of pass-through entities anyway, and the reason that this is important from an individual standpoint is that pass-through entities for Pennsylvania purposes are taxed, you look to the individual income tax code in Pennsylvania, so it's a little bit different from some other states that way. But what they've put out is that for the repatriated transition tax income, so that, you know, that 965, again, that being a deemed dividend mostly, in most cases, and not an actual distribution, then it's not considered a dividend for personal income tax purposes in Pennsylvania. So what that means is that if you've got that deemed dividend, then they're going to want that adjusted out of the tax base on what they have as a Schedule M, which is basically just their adjustments out of the Pennsylvania Passthrough Entity form. And then if there's an actual distribution, when and if there's an actual distribution of cash out of E&P that's made, then that would be subject to personal income tax in Pennsylvania. So on that deemed dividend, just know that right now Pennsylvania is looking at having that adjusted out. Okay, and that brings us to our next polling question. Pennsylvania imposes which taxes on pass-through entities? A minimum tax, an annual filing fee, all of the above, or none of the above? And the answer is none of the above. Maybe a little trick question for everybody. Okay. I'm going to mention local income taxes because Pennsylvania is one of the few states out there that imposes basically city income taxes. And I have income taxes up here, that there are some jurisdictions in Pennsylvania that impose what are considered more like gross receipts taxes. There at the bottom, Scranton is one of them. Now, these are just, I mean, this is not a laundry list of the cities that impose taxes. There are many, many, many jurisdictions in Pennsylvania that impose at least that business privilege tax that Scranton has, or something like it. Pittsburgh has what they call an individual earned income tax, and that's basically on wages. Philadelphia has that as well, but Philadelphia has a lot of entity level income taxes that sometimes can catch taxpayers off guard. So if you have a situation where you own property in Philadelphia, or you have a remote employee in Philadelphia, I strongly encourage, and you're not filing there, I strongly encourage you to get registered and get compliant there, because they're pretty aggressive and they do impose like a business income and a net profits tax. That net profits tax is more like a gross receipts tax, but they impose those even on partnerships. So sometimes we have situations where we've got pass-through entities that think, oh, you know, we're doing business in Pennsylvania, all the income passes through to the shareholder, the partners or shareholders, and they're the ones that are subject to the tax. Well, not so in Philadelphia. Philadelphia taxes those at the entity level, and sometimes that can catch taxpayers by surprise. So just warning on that, and like I said, Philadelphia is pretty aggressive, and they are pretty active. They'll send notices, and so I just caution you, if you're going to do business, or maybe you already are doing business in Philly, to take a look at that. And with that, that summarizes, or kind of concludes the income tax piece. So now I'm going to throw it back to Jennifer to go through canceling a sales tax license in Pennsylvania once you've exited.
Thank you, Stacy. Yeah, we'll just wrap up here quick. After we've now talked about sales tax and when we need to file, and income tax and what we need to file, and we're registered in the state, but if we cease doing business in the state, we're not going to do business anymore, the business has been sold, we have no more operations in the state, that is when you then have to consider canceling out or closing down your sales and use tax license. And I'm talking about sales and use tax license, but this same form you can actually use to close out many of your different accounts within the state. Like if you have withholding, or public transportation assistance fund taxes, fees, vehicle rental, cigarette tax, those types of things can all be done in this process. But keep in mind that, as we're talking through this, we're really talking about when you've really ceased doing businesses in the state, discontinued operations. Not if you just had an employee there that's no longer there, but if you're still making sales into the state, the business is still potentially doing business, that's not when you cancel that registration. Because as we talked about earlier, now that Pennsylvania does have those reporting requirements, they may be required to be registered just by having $10,000 or more of sales into the state. But if you have ceased doing business, no more operations in the state, there's Form REV 1706 that you submit, you complete and submit that. As I mentioned, that form can be used for the multiple taxes, including sales and use tax and other employer withholding type taxes that you would be filing in the state. But the key piece of all this, and you're doing all that, is making sure that you have filed all outstanding tax returns, that all applicable taxes, fees, penalties, interest, any outstanding liabilities that are out there for the state have been paid and all returns have been filed, whether that's income tax, whether that's sales tax, any other tax reports that are due. In order to get completely closed out, canceled out of the state, you need to make sure that all outstanding liabilities have been remitted and paid to the state. And that form can be done online. I believe there is also a paper version that can be done too if you so choose. All right, and that takes us to our last polling question. I would like to see future presentations on economic nexus implications and sales tax collecting and remitting, state income tax implications relating to federal tax reform, or surviving a sales and use tax audit. As we think about different presentations, we just like to get feedback from our clients and those attendees to what would be of interest to you. All right, well, that's great information for us, so thank you. All right, so with that, thank you so much for joining us today. I think we may have, if there are any questions out there, if there's any, Tara, have there been any questions sent in to the